If you are a high-income, highly confident young man, statistics show you are precisely the demographic most likely to fall for deceptive financial marketing. The philosopher Harry Frankfurt coined a specific term for this kind of advertising: bullshit. That doesn't necessarily mean the ads are outright lying. It means they operate with a strategic indifference to the full truth, deliberately leaving out the context you need to make a good decision. The core rule of financial advertising is simple. The products pushed the most aggressively are always the ones that generate the highest profits for the firms selling them. Because investing is ultimately a math equation, those massive corporate profits have to come from somewhere. You, the retail investor, are the one funding them through higher hidden costs and lower realized returns. To persuade you to buy these products, the industry relies on a playbook of 5 specific psychological techniques designed to bypass your critical thinking. Recognizing these patterns allows you to separate a product's true value from its marketing, which is a necessary step toward keeping your returns for yourself. The first technique is salience. This is the tactic of isolating one thrilling, attention-grabbing metric to intentionally blind you to the underlying risks and costs. You see this constantly in ads for covered call ETFs and private credit funds. They weaponize salience by screaming about massive target yields, flashing numbers like 9.6% right across your screen. This chart shows exactly why that is deceptive. That massive 9.6% yield suddenly shrinks down to a much smaller total return. Because these underlying loans are volatile, capital depreciation often wipes out the cash flow. Total return, the actual change in your net worth, is the only metric that matters. The second technique is framing. Marketers use empty, positive language to build a safe, appealing mental box around a dangerous product. Brokerages love to advertise the power of margin and the opportunity of borrowing against your investments. But they ignore the empirical reality. Retail investors who trade on margin trade more speculatively, more frequently, and consistently less profitably than those using cash. The power described in the marketing copy rarely builds your net worth. It flows directly toward the brokerage in the form of steady interest payments. Technique 3 is transference. This involves borrowing credibility from a genuinely positive concept and pasting it onto a toxic one to gain unearned trust. Options trading platforms weaponize this by heavily promoting zero commissions, a trait they borrowed directly from the low-cost index fund movement. This diagram illustrates the hidden cost behind those free trades. Instead of sending your options trade directly to an exchange, the brokerage routes your order to a third-party market maker in an arrangement called payment for order flow. Because the market maker profits off the difference between the buying and selling price, the bid-ask spread, those spreads widen significantly. Retail traders collectively lose billions of dollars to these indirect costs. Then there is shrouding. This involves hyping an exciting narrative while burying the historical data and actual costs deep in the fine print. Consider thematic ETFs, like those focused on space exploration. They sell an incredible story. Yet the data shows that 100% of Canadian-listed thematic funds eventually close down or underperform the broader market over long horizons. By the time a theme becomes exciting enough to sell a fund, the high stock prices are already baked in. The shrouded reality is a high probability of loss over the long term. The final technique is complexity. Firms engineer a product to be so difficult to evaluate that you abandon the math entirely and default to manipulated intuition. Private equity is the prime offender. Because their underlying assets aren't traded daily on a public exchange, the funds calculate their own value, a process called return smoothing. It makes the investment appear low risk and uncorrelated to market volatility. But when researchers properly benchmark these funds against public equities and adjust for the risk of illiquidity, meaning you can't get your money out when you want to, the outperformance disappears. This representation of financial reporting explains why these products are pushed so hard. Billions of dollars flow directly from private equity funds to the banks and wealth managers who recommend them to their clients. This complexity creates an information barrier that hides the direct transfer of wealth from your account to the industry middleman. The modern financial landscape operates as an engineered ecosystem, optimized to extract wealth from confident, underinformed retail traders. But you don't have to be the victim of the system. Once you understand the underlying mechanics, you can use the industry's own structure to your advantage. Look at this scale representing brokerage revenue. Financial firms can only afford to offer loss leaders, like free basic trading and ultra-low-cost index funds, because they generate profits off the users trapped in high-margin products on the other side. Your strategy is simple. Ignore the marketing. Refuse the margin loans, skip the options trading, and exclusively utilize the unadvertised low-cost services. By staying disciplined and sticking to boring, unmarketed investments, you are effectively letting the overconfident losers of the financial game subsidize your own wealth accumulation.